There is a huge, almost unstoppable change happening right now in the world of wealth. It's so big, it's creating a completely new playbook for how money is managed. So, what on earth does this mean for the future of investing? Let's dive in and break it down. Okay, I want you to picture a tidal wave, but instead of water, it's money. We are talking about an $83 trillion tidal wave of wealth that's in the process of changing hands. The sheer scale is, well, it's staggering, and it's on track to completely reshape the entire investment landscape as we know it.
But look, this isn't happening in some calm, predictable bubble. No way. This great wealth transfer is unfolding in some seriously choppy waters, forcing pretty much everyone, investors and their advisors, to figure out how to navigate a new world of constant risk. Let's start with a number that really, and I mean really, captures the mood right now: 86%. This one figure, it's the key to understanding the mindset of today's wealthy investor. That's right, an absolutely overwhelming majority of high net worth folks are more worried than ever about things like global politics and trade policy. So this anxiety, it's basically the wallpaper for every single investment decision being made today. It's the backdrop to everything. And it's not just us saying this, industry leaders are seeing it loud and clear. As Nick Dreckman from Julius Baer points out here, the growth is still going to happen, but it's happening in a world where uncertainty is the new normal. The big question is, how do you adapt to it? And that whole idea of adaptation, well, it has everything to do with who is now taking the helm. A new generation of investors is inheriting all this capital, and you know what? They've got a completely different map and a totally different compass. By 2048, we're looking at an estimated $83.5 trillion being passed down to Gen X, Millennials, and Gen Z. This isn't just a simple transfer of money. Nope, this is a transfer of power and, crucially, perspective. And the difference between these generations, it is night and day. Just look at this. While baby boomers were largely focused on just preserving the wealth they had with traditional assets, this next generation, they're all about growth. They're comfortable with taking risks, they actively seek out alternative and digital assets, and they expect to manage the whole shebang through a screen, not in some stuffy office. And why not? They grew up digital. For them, having instant access and control isn't just a nice-to-have, it's an absolute baseline expectation. Now, get ready for this next number, because it should send an absolute shockwave through the entire financial industry: 81%. This one statistic reveals just how disruptive this new generation is going to be. Yup, that is the percentage of these new investors who are planning to just fire their parents' financial advisor. They don't feel a connection, they don't think they're understood, and they are more than ready to walk out the door. So for the established firms, this is a massive threat. The message is crystal clear: adapt, or you're going to become a fossil. All right, so if they're ditching the old guard, where in the world are they putting this incredible amount of capital? Let's take a look at the new treasure map. It's a simple question, right? But the answer, well, the answer reveals a fundamental shift in what we even consider a valuable and safe asset here in the 21st century. And this chart, it tells a huge part of the story. In a world of digital everything and, geopolitical craziness, there's a massive flight back to things you can actually touch, real, tangible assets. I mean, look at this chart from UBS. Demand for gold from both investors and central banks is just surging, pushing prices to record highs. And the experts, they think this is just the warm-up. UBS have jacked up its 2026 price target for gold to a stunning $6,200 an ounce. Just let that sink in for a second. That shows an incredible amount of confidence in hard assets as a shield against all this volatility. But it's not just about gold, not at all. This trend is spreading across a whole category of investments that live outside the traditional stock market. As MSCI reports, the vast majority of advisors now see having a solid lineup of private asset offerings as absolutely essential if they want to meet their clients' demands. So what are we actually talking about here? Let's demystify this a bit. Private equity and credit. Think of it like getting in on the ground floor of a company way before it ever goes public on the stock market. Hedge funds, they use these really complex strategies to try and make money no matter which way the market is going. And then, of course, you've got tangible commodities and, yes, digital assets like crypto. These are the new tools in the toolbox that the next generation is using to build their portfolios, hunting for higher returns and moving away from the same old, same old.
Of course, to manage all this complex stuff, you can't just use a spreadsheet and a flip phone, right? You need the right tools. And that is exactly where technology, especially artificial intelligence, storms onto the scene.
But there's a pretty big problem here. While a ton of money is being poured into AI, there's this huge perception gap. Look at this. Almost 3 out of 4 people in the industry feel like wealth management is playing catch-up, that it's lagging behind other financial sectors in adopting AI. They feel like they're falling behind.
And this isn't just some vague feeling, okay? It is a real-world, practical problem. Nearly half of all financial advisors are actively unhappy with the tech their own firms are giving them. And that tech deficit makes it so much harder to give the kind of personalized, slick service that their new clients are demanding.
So, what's the takeaway from all this? How do firms actually survive this sea change and chart a new course? Well, it all comes down to a new playbook. The path forward is actually pretty clear. The new playbook really boils down to 3 big moves. First, firms have got to tailor their strategies to include the private assets and global diversification this new generation craves. Second, they have to adapt their service to be digital first and hyper-personalized. And finally, and this is the glue that holds it all together, they have to empower their advisors with the AI and tech they need to actually deliver on those first 2 points. So this new playbook, it's a direct response to a more volatile and frankly, a more complicated world. It's a strategy built on diversification, technology, and adaptation. But here's the big question we're left with. Is this new approach really about building the next wave of great fortunes, or is it just a more sophisticated defense to protect the wealth that already exists? I guess only time will tell.